Hello, friends. Welcome to the first module in my investment course. Now, I'm going to set a couple of principles and a general foundation as we move along in this course. The first thing is to know that financial literacy is the foundation for everything you're going to do in your investment life. And that's because it helps you ask informed questions. So when a deal is presented to you and an opportunity comes your way, you know the right questions to ask. It helps you to do your due diligence as well. So you have a roster of financial professionals on speed dial. You kind of know what types of due diligence to do for any deal before you then make a decision. It also makes your decision making faster because over time you develop an intuition. You kind of know what are the red flags, what are the things to look out for. So you need financial literacy as the foundation as you go along your investment journey. So I'm going to share 20 principles you should know. The first thing is please invest in what you understand. For those who live in the diaspora, you can walk into any bank or any financial services organization and ask to see a licensed investment professional and get free advice. You don't need to pay. So whatever it is you're watching on TikTok or YouTube, you know a friend told you about an investment or an asset class, simply walk into the nearest financial institution and book an appointment ahead of time and just ask questions, sound them out. You will be amazed, further insights that you can get. So if you don't understand something, there are a lot of free resources out there. Thankfully, with AI, you're able to search better. You're able to search more intelligently for information. So please understand an investment class first. At least watch a couple of videos and then go talk to a licensed professional. The next thing is please know your risk profile. There are a lot of people who don't want to lose any money. You're a conservative investor, but yet you say you want 30% return on investment. It's never going to happen. Risk is proportional to reward. And even in taking risk, please don't invest in more than what you can afford to lose. So if you're going to do anything high risk, at the back of your mind, just ask yourself, if I ever lose this money, am I going to cry? If the answer is yes, you're better off not investing that amount of money. So please, if you have a low risk profile, don't invest in anything high risk, no matter how sensational it appears. Start small. A good rule of thumb is to have a certain percentage that you deduct from your disposable income every month, and you dedicate that to an investment. No matter how small it seems, just having that percentage keeps you disciplined in life. So as your disposable income increases, the volume of what you invest increases, but you maintain a certain percentage. And that's where consistency comes in, because you don't know the value until years down the line. If you're young, you don't have a lot of responsibilities. It means you can devote more of your disposable income to investing now. And if you're consistent over 5 years, you will be amazed what that investment will become, and it's going to give you a lot of choices in life. So please be consistent. Don't leave funds lying fallow. Lock it up immediately. That's part of the discipline. And one of the reasons why a lot of people break their investment even when there's no emergency is because they put it in investments that are easy to break. So sometimes when you invest and there's a penalty, or you're going to pay taxes if you break that investment, it's a deterrent. So you're not kind of quick to go to your investment anytime you need money. And a good thing to do is to have a separate emergency fund. So that's kind of like the fund that you can go to if you have an emergency without necessarily touching your investment plan. So don't leave your money in your savings account or your current account. That's why it's good to have that percentage that you deduct every month. It's great to use a direct debit as well. So you're disciplined and you're able to immediately hide the money once it comes in. Please move fast, and this is where financial literacy comes in. A lot of times opportunities don't wait around for long, but if you have a foundation of financial literacy, you know the right people to talk to, you're able to do your due diligence, that means your decision making becomes faster and you're able to take advantage of an opportunity in an informed manner. By the time you're hearing about an investment, a lot of times, it's already too expensive. By the time it becomes popular, we've gone through so many cycles. There was a time cryptocurrency was hot, then real estate, then ETFs, in terms of exchange traded funds and stocks. Different things are popular at different times, but a lot of times, by the time people are rushing into an investment, it's already too expensive. Warren Buffett said it best. Sometimes the best time to invest is when other people are exiting. As long as the fundamentals are sound and it's going to come round again, the cycle is going to come round again. Sometimes the best time is when the prices have crashed and everybody else is moving out of that investment. So try not to pay top dollar for a lot of investment opportunities, especially when everybody else is crowding into it. Look for the lowest cost of funds. There's no reason to pay for a house upfront with cash. There's no reason to pay for a car upfront with cash. For my friends in the diaspora, you know that you can always get credit. For my friends in Africa, you know that sometimes if you've been out of a job, say for a year or two, you can dip into your pension funds to start a business. So that's low cost of funds. You don't need to borrow from the bank if that sort of arrangement is available to you in Africa. So as much as possible, if you can get a mortgage, you can also shop around. Look for the lowest rates that you can get. Shop around. And that's one of the reasons why your credit has to be good, so that way you can get credit when you need to for really expensive assets and you're not having to pay out of pocket. So please look for the lowest cost. Don't be quick to pay cash for everything, but use leverage with caution. Leverage in this context is debt. Don't take debt for consumption. Take debt for buying an asset and for investment, because you know that the return on that investment can more than take care of the rates that you're getting for that debt. So people that are financially astute only take debt or only use leverage for investing or to buy an asset that's much more than the debt that they're taking. Please don't put all your eggs in one basket. I don't care if it's your friend that recommended an investment or your mother. Don't put everything you have in one investment plan, and as much as possible, don't put everything you have in one asset class. If that asset class, there's a major risk across the entire country in that particular asset class, you may cry. So please diversify, spread your risk as much as possible so that if something happens to one bucket, the other bucket still survives. Please safeguard your principal. This is especially for those who do high risk investments, forex, cryptocurrency, stocks. A lot of times, it's best once you've gotten a windfall, take out your principal. And then if you want to speculate with your profit, please go ahead. Some people do it the other way around. That's fine. They take profit a little at a time. The idea is just you're minimizing your risk. So you're not kind of doing you're rolling over ad nauseum. Don't get sucked into that trap where you keep rolling over a high risk investment. At some point, please take out your principal or your profit. Do your due diligence. Have professionals on speed dial. You must know a good lawyer. You must know a good CPA or registered financial professional. Have those people on speed dial, because again, if you need to move fast on an investment, you need to be able to call an expert and say, review this contract, review the terms. What do you think? Does this sound like a good idea? Please do your due diligence. And it's good to pay a little so that you don't lose a lot. If you're planning to do a deal in the hundreds of thousands or in the millions, why don't you just pay a little, to run your due diligence? And there are a lot of professional firms out there that you can pay to help you run due diligence. So please don't rush into an investment. Beware of Ponzi schemes. Anything that looks too good to be true, or anything that requires fresh investors to come in before the organization can pay earlier investors. A lot of times those are red flags. It means the entire structure can come crashing down like a pack of cards. And sometimes some red flags could include you're dealing with a financial organization and you're saying, can I see your audited accounts? Can I see your corporate registration? Can I see your reports? Any credible firm that's public and it's not a privately held company should be able to make available those documents. By the time they're kind of hemming and hawing and they're not making those documents available to you, that's also a red flag. So please beware. The future is cooperation, very, very important. It's one of the reasons I have an investment club, because when you come together as a group, you're able to pool more capital and get access to deals that you would ordinarily not be able to as an individual. My investment club has thousands of members, and we have a professional fund manager as the honest arbiter in the middle. So even though some members are strangers, but because we have that fund manager that provides due diligence and advice, we're able to come together as a group to do deals. So please, cooperation. If you have friends, everyone kind of bringing in their capital to take advantage of some opportunity, as long as you can get a trusted third party who kind of looks over the interests of everyone within the group. I always recommend that. Have a trusted independent advisor in the middle of your group. Track your spending. This is great. A lot of phones come with apps that help you track your spending. You can download one. What it does is that at the end of the year, when you're looking back, some of those apps help you automatically create charts and graphs. You look at a pie chart and what was the biggest slice in my spending? Did I spend most of my money on food, or did I spend most of my? Did I give out enough in terms of philanthropy or just giving? How much did I spend on self-care or education or self-improvement? It just gives you a sense of what your priorities are, and also tells you, okay, what expenses can you reduce so that you free up more money for investing. Please compound over time. If you're young, there's a module in this investment course where I talk about a 5-year plan for financial independence. If you're young and you don't have a lot of responsibilities, now is a great time to invest and just keep compounding that investment over many years. By the time you need to pay for kids' education, or you need to start a business, or you want to get a second degree, that investment you started 5 years ago gives you choices. You suddenly have options. You don't need to you can take a gap year. You can decide to travel the world because you have options. So I would say, if you're trying to be financially independent, at least give yourself 5 years from whenever you start, and just be consistent. Don't break your investment. Just keep compounding, keep diversifying, and let's see where you are in 5 years. Please be mindful of fees, taxes, and currency risk, especially if you invest across jurisdictions. You don't want to kind of invest in one currency, the currency you spend at home, and then you invest in another currency, and sometimes if there's any kind of sudden movement in exchange rates, you're caught unawares. Also ask about fees. So a lot of times when you invest, look at what will the taxes be? Is this investment tax-free? Is there withholding tax? So for example, if you invest in stocks and you sell your stocks, you know that you're going to pay taxes, capital gains tax or withholding tax, as the case may be. So you need to ask questions anytime you're presented with an investment opportunity. Ask a professional, what are the tax implications of this opportunity? Is there a beneficial way of structuring it such that I don't need to pay anything more than I should? And what are the fees? Ask those questions. Next of kin is not a beneficiary. This is for my friends in Africa. If you're opening an investment account and you're asked for your next of kin, that's your emergency contact. It doesn't mean if anything happens to you, that investment is going to automatically go to your next of kin. So please, you need to have a will as you begin to invest, so that it's clearly known who your beneficiary is. If anything were to happen to you, especially if you have dependents or you have a spouse, please note that next of kin does not automatically mean a beneficiary. Another thing that's important is to kind of know that if you're running a business, make sure you have a clear operating agreement. Again, if anything happens to one of the founders, anything happens to one of the investors, you don't want family to kind of get involved, in a business. So if you have a clear operating agreement, it's pretty straightforward. If any of the founders is indisposed, this is what happens to their shares. This is, does it go to their family? It's just very clear. So please have that in mind. Finally, you need experts. I always say this: have a lawyer on speed dial, have a licensed financial professional on speed dial, and that's because there are times when you're going to need to make a quick decision, and if you don't have the financial literacy, or you don't know that much about that investment class or that asset, you might not be able to make a good decision. So sometimes just having those experts in your corner, even if you have to pay for advice, you have to pay for expertise, it's better to pay a little now than to lose a lot, especially if you're doing deals in hundreds of thousands or millions. Please pay for an expert, or like I said, there's some that are free. You can walk into a bank, but for specialized transactions, chances are you're going to need to pay for an expert. It's one of the reasons why I set up my wealth mastermind group, so that I can talk to people one-on-one, and I can really just have a small group for people who need more specialized information than they would generally get from a free course. And then finally, please know when to stop. This again is for my high risk friends. Take your profit. A lot of times, once you have a target, be disciplined. If you've hit your target, liquidate that investment, or at least take out your principal, and then if you want to speculate with your profit, you can go ahead. But please know when to stop, particularly for high risk investments. So I'll see you in the next video, in the next module. Thanks for listening, and I wish you all the best.